So broadly speaking, our offerings will be into three buckets. One are the open-ended funds, like any mutual funds you have in India. You can invest anytime, you can divest anytime you want to do out there. Except the fact that we run both set of funds, which are leveraged and which are unleveraged.
Sure.
Second is the fixed channel fund, which are called FMPs in India. Used to be very popular in good old days.
Yes.
So that's extremely popular because when people invest ex-India, they invest for, among other things, to preserve it, to create a golden nest, to diversify. And they have a reasonable assurance what the returns they want to get across out there. So FMP is extremely popular out there. And third is the bespoke funds.
Sure.
So good old days till about 2000, and the family offices used to make a trust in terms of next generation wealth transfer.
Yeah.
Now most of the large families used a fund structure to do it out there. To summarize, open funds, FMPs, and bespoke solutions.
Perfect. Perfect. If you could kind of elaborate a little more and give few examples, that will be helpful to our audience.
Sure. So even before going that, I want to highlight one important distinction. Ex-India, when you invest into fixed income, you would most likely than not take leverage, which is not possible in India.
Right.
So this is a very important distinction to be made.
Absolutely.
So when you invest ex-India, for example, in buying properties, you will typically take a mortgage.
Yes.
Right? As a matter of fact, even in India, you have seen most of the large metros, in the heart of the metro, the property prices are really not appreciating.
Yes.
Right?
Yes.
Right? So the core of the takeaway to you is that ex-India, when you invest, you typically use leverage.
Yes.
Now, very simply, if you can invest into a bond which gives you 7% per annum, and bank is happy to give you a loan at 4% per annum, it's no-brainer. Right? So we of course have the LAS India, like loan against securities, that's what it's called.
That's what it's called. Yes.
Yeah. So the key point there is that the way you have loan against securities, ex-India, the largest chunk in the world, and I'm talking about $300 to $400 trillion, largest chunk in the world would have certain amount of leverage built into it. So by using leverage, you can enhance your returns. Simplifying, if you put $100 at 7%, you make $7. But if you can leverage 1:1 on $200 at 7%, you'll make $14. And if you take your cost of borrowing to be $4, on the $100 of borrowing you've done at 4%, you would pay $4 as interest cost. Therefore, your net income is 14 minus 4 is equal to $10, almost 10%.
Sure.
That's something which is unique ex-India. And that's one of the core competency of Silverdale.
Sure.
So in the niche market of high quality short duration, we are one of the global leaders in terms of doing this. Of course, the variants of this, a lot of people would have heard, it's called risk parity.
Yeah.
And they have about $7 to $8 trillion in the world using the same strategy. But we do use a very, very basic form of managing it across out there.
Sure. A 7% bond, just because of the sheer leverage, the net return, even after adjusting for the cost of leverage, comes to about 10%, which is a 300 basis points additional return. But in general, leverage also is associated with higher risk. How do you manage that risk?
Absolutely correct. So let me go very simply. If the bank is going to give you leverage against Reliance Industries,
Yeah.
will you take leverage?
Absolutely.
If the bank is happy to give you with ABC housing finance company, will you take it?
Think twice.
Unlikely, right?
Yes.
So the key point is what I mentioned earlier also. As Silverdale, our core is in terms of being ultra conservative, in terms of being high quality.
Sure.
I want to highlight this thing for benefit of the viewers. In case of equities, you are able to beat the index by taking concentration risk. Let's simplify. If index has 5 securities, you buy the 5 securities in the same proportion, you can never beat the index.
Yeah.
Right? So you buy 4 securities, theoretically speaking, you can beat the index. But in the fixed income space, remember, my upside is always capped to par value.
Yeah. Yeah. Yeah.
Right? Bond will always pay par value to me at the end of the story.
Yeah. Yeah.
So for me, diversification is the single most important thing.
Yeah.
So I'm extremely well diversified across the portfolio. Now the beauty is this: if you're more diversified, you have higher loan to value.
Yeah.
You have higher quality, you have higher loan to value.
Yeah.
If short duration, you have higher loan to value.
Yeah.
So what you have noticed is I've increased the quality, reduced the duration, make it diversify more by making the quality of the portfolio really better.
Sure.
Higher the quality of portfolio, lower the return. We understand it.
Sure.
But now we add leverage to it so that on a risk-adjusted basis, you're getting a much higher return than the risk you take.
Sure.
And that's the key.